I'm saying. Can you line proceed, please?
Good morning.
Hello. Everybody hear me okay?
Yes.
Yes.
Okay.
Yeah.
Give a couple more minutes here for anyone else to pop in.
Can you hear us here in Port Charlotte?
Yeah.
Thank you.
Bring your hot one. Whatever you.
What's that? Oh, okay. Okay, well, I guess that's all we're getting here today. Okay, so streamlining is really meant to kind of simplify everything. I know it's a bit of a complex kind of sounding process here at first, and it is a bit of a change to the way you have kind of done things, and the general idea that you have to verify everything down to the penny every single time. But finally, HUD has kind of given us something that lets us work a little bit more efficiently, at least every few years. So the idea behind it, as explained in that HOTMA presentation I did the other week, is in the first year of something, or year one of a 3-year cycle, you're going to do that complete full verification, which is your traditional third-party verification, sending out the letters to all the places and that fun stuff, for income and assets. This doesn't have anything to do with medical expenses. That stuff is still the same. But for income and assets, those are your things that can be streamlined. There are 3 kind of components of streamlining, 2 of which are tied to income, and then the other one is the assets. Start with the assets one, since that's generally the easier one. So in year one, of course, you're doing full verification, sending out your letters to the banks, to the stock company, the stockholders, all those fun things. And then in years 2 and 3, they simply fill out that self-certification form, and we kind of go with what's on that form, as long as it's reasonably accurate. And you can kind of compare it a little bit to last year, make sure they're not leaving out some particular account or whatever. But the actual language with HUD is that it doesn't, once they fill out and do that self-certification form in front of you, no additional verification is needed to be done. So you don't need to look into interest rates or really do anything else. Just kind of take what they got and put it into the system. You are still needing to do income, of course, from there, but they're going to put that information on there for the sources that they know the income. So if they have a checking account or something, if they know it's 0.5%, then they can put that 0.5% on there. If they don't know what it is, then they need to put that it's unknown and you just don't include it. Even if you know that there was a 0.5% last year, if they put that they don't know it on the form, then you go with that. And the general idea behind that is because assets really don't have a huge impact on your rent calculations, especially when you're talking about the amount for streamlining, which was 5,000, but is now at the annual amount of 50,000 for next year. So assets under 50,000, unless they're getting a significant amount of income from it, it's really not going to be having much impact. So that's why HUD's kind of just like saying, okay, take what they say and move on to more important things. That's probably also why they took the retirement accounts out of being included as assets, because generally those kind of pay out a lot more income than, you know, a CD or a checking account and savings, those kinds of things. So that's basically the idea with the verification of assets. As far as income, you have fixed income and you have not fixed income. Those are the two facets of it for streamlining. The first one, fixed income, is for everybody that has any sort of fixed income source. That fixed income source, like Social Security or a VA pension or, you know, an annuity or something along those lines, that's just paying a regular periodic amount, including required minimum distributions, those are considered fixed income, and you will still need to verify it using traditional full verification methods in year one. But then in the second and third year, you can just take exactly what they put on the form, the self-certification form for that source. Now, the only caveat with that is with the EIV stuff, so Social Security and SSI, we still need to use EIV, and I don't have a clarification yet from North Tampa on whether they, on the definition of, or at least the clarification of the look back period for the annual research, but she did say that if we put it into our policies, that we can just use EIV as the streamlining source. So if they have a Social Security thing that's in EIV, you're still going to have them put it on the self-certification form, and you're still going to get your EIV report every year like normal, but then you can just use what's in EIV and put all that stuff in the file and move on. But if they have something like a VA pension, you're still going to print out EIV because you need that at every AR, but you're going to take what they put on the self-certification form, and then you can use the published COLA amount that's out online or whatever, and manually calculate what their new VA amount is for that particular year two, or again in year three.
Just for, I get a VA pension, Brian, and I get a every January as to what that pension is going to be. That document, would that still be acceptable?
Yes, I mean, if they have it, and then I would just have them put that amount on the self-certification form.
Okay.
You don't need anything really besides that self-certification form and the EIV paperwork. Or if you're using a COLA thing and manually calculating, you'll need something printed out showing what that COLA amount is for the file. But the certification forms are going to be doing that in front of you with you, because it has to be either notarized or witnessed, them doing it in front of you. Plus, you can kind of help them with the forms, because as we'll get to in a minute, they can be rather confusing, especially since they're new, until they kind of get used to it, because there's a lot of questions to cover all the bases. Kind of like the questionnaire itself has a lot of questions, but that one's a little easier for them to kind of go through and do on their own, and then you can use that to assist them somewhat through that self-certification form. So the other portion of it is the not fixed income. Now, to streamline not fixed income, the household has to be considered a fixed income family. And the definition for that is in the procedures and all that, but it essentially means that 90%, at least 90% of their income has to be from a fixed income source. And then if that not fixed income is at least less than the other 10%, then you can streamline that not fixed income as well as the fixed income. And the way that you streamline that is just by taking what they put on there or using the same exact amount that you used in year one. So if a person works a little, maybe at the front desk or some little part-time job, and they have the Social Security, you're going to have them fill out that self-certification form. They're going to put their amount for Social Security. You'll print out the EIV. They'll use what's in that EIV amount, and then on that self-certification form, they'll also put in how much they got annually in their wages. It should be, reasonably close to what you verified in the first year. But if they've reduced hours or whatever else, you still just use what they've put on there. Or you can use the amount that you put in year one if you think what they put is not quite close to correct or something like that. But really, when it makes up that 10% or less, HUD's just saying that, it's not going to have as much of an impact whether they're talking about a few $100, a year or not. If it's off a little bit, it's not a big deal. You'll get it in the next few years. Okay, so that's kind of the biggest way you got to turn your thinking a little bit. Yes, in year one, we're doing that full verification, and then year 2 and 3, we're kind of just taking what they say for the most part, other than from the fixed income stuff. That is pretty easy to calculate and get correct, which should make up at least 90% or more of their income. Now, the people that only have a job, there are some of those as well. And you still print out EIV because you need EIV all the time, every annual, but you wouldn't be able to streamline the income portion of that because if it's 100% of their income, you would just verify that, sending it out to their employer or getting the work number verification, however you would normally traditionally verify that every year. But you can very much likely still streamline their asset. So what that brings me to next is the whole 3-year cycle. You want to kind of keep the income and the assets in the same yearly cycle. There can be things that disrupt that cycle for one or the other or both, but if it's just one or the other, then you want to make sure to just reset both cycles and start at year one. So right now, a lot of you have done certifications for the 2023 annuals, which can be considered year one, and then their 2024 annuals can be considered year two, for both. And it'll kind of keep everybody in line for the time being. But if something happens, like somebody moves into the household, or somebody moves out of the household, or dies, or they change from having a job and start getting Social Security because they became of age or whatever, that's kind of a critical change that would break one of the cycles, and you would just need to do a full verification of all their income and their assets and just restart at year one. But then the following year for that person, or that household rather, you can start at year two for their cycle there, which you're not going to have the whole building in the same cycles, but as long as you're documenting it using the checklist, there will be a couple of years for every household that this process is significantly sped up by.
Hey, Brian.
Yeah.
So did you just say that all the 2023 annual certs can count as year one?
Yes,
So like someone that has a January 2023 AR, when they get recertified coming up, this is going to be year two?
it can be, yes. And that's my suggestion because of the way that Hotma is trying to make us verify income at annual research next year, starting in 2024. Now, I will say there has been some things posted here and there, unofficial, that this Hotma implementation thing could get delayed a little bit because some stuff still needs to be clarified quite a bit by a lot of different organizations that are part of that whole industry group, including North Tampa and something kind of unofficial from RealPage, but nothing from HUD has said that yet. So we kind of got to assume that that's still on the path to occurring here in January. I'm not saying you have to start this as year two with January research, but there's really no reason not to at this point. And it's, if you've already kind of started doing verifications, you can just have them do that self-certification form and just get rid of those third-party letters that you did and just use it as year two. You did a little bit of extra work that you can kind of just remove. So, does that make sense?
Yeah, I mean, as long as it is going to be what actually happens, you say that it's,
Well, even if Hotma doesn't go into effect, that doesn't eliminate the whole streamlining thing. I think that certain portions of it, because there's like 3 different major sections of Hotma, and I don't think that the portions that apply to streamlining will have any delay in being impacted as far as like the $50,000 threshold, because currently it's 5,000 for 2023. That's the amount since it went into place, which kind of made it a little more difficult because some of the residents did have assets over 5,000, so that would eliminate them from the asset streamlining, and it just made it difficult to really implement previously. But at that 50K threshold, it's much more feasible and makes sense to really do it. It doesn't make sense not to do it. Let's say that.
and it's still the 0.06%. If they don't,
Ye-
if they're not making that,
It's 0.06% for imputing income on assets that have unknown income. But you don't do that if it's under 50,000. They're not imputing anything
Right,
when you're
over
doing
50,000.
streamlining. Yeah, if it's over 50,000, then you're going to do the imputed calculation on everything, on the total of all assets that have unknown income.
okay,
But-
is the $525 deduction, that's gonna start January 1, right?
Yes,
When is that gonna be in the system?
once we flip the switch in one site to switch over to that new tracks 202 or 203A.
Yes.
So it has to do with tracks. Do you know when that's gonna be?
Not 100%, but the notice that I got from RealPage said that they are on track and ready to go with it. But as described kind of in that meeting I did there last month, once we do flip that switch, well, a lot of those certs are going to be done in this old system in 202D now with the $400 deduction and everything else. But once we flip the switch, the system is going to do automatic corrections to all of those 2024 research that makes them have the new calculations and such that are part of the 202 or 203A system, which could result in a higher rent or refunds, you know, whatever it may be. But I'm hoping to do it as soon as possible to prevent all of those additional corrections, because it's going to make the HAPs crazy, and they're already going to be crazy because that form has changed with the new tracks. So
So do you think it's gonna be before the end of November?
no,
No.
It can't be before January.
But the research have to be done before December 1st.
Yeah, you're gonna do them now in the system, in the way that it is now, in the old way, and complete them. But once we flip the switch in January or February or March, whenever the heck it is, the system is automatically going to go back and correct all of those January ARs that were in the old way and correct all the February ones for every research that you finalize at this time.
If the rent goes up, do they have to get 30 days notice?
Yes.
Okay, that still applies.
Oh yeah, yeah. If the rent goes up because of the change in the calculations from this switch, then yeah. But you will still get that difference for that month from HUD on your next voucher.
So whenever the switch is flipped, basically whatever the system determines the rent is correct. Based on the information that's there, as long as
Yeah.
it's correct.
Yeah.
Okay.
To the best of my knowledge, I mean, one site does have its little quirks and things, and it may bug up, especially if you're doing it at the same time that the rest of the country is doing all these things. It could have some issues. So you still want to check these things, the corrections that it did, but it shouldn't have, too many problems. It should be correct.
Okay, so we use a worksheet. Will we need to redo the worksheet in the system when the switch is flipped?
You mean like that long form
Yeah.
manual calculation? Yeah, that will probably need to be adjusted. And you may need different ones because of the
Yeah, it's gonna have to be.
the different amounts.
Yeah, the percent, well, yeah, well, that leads me to another question. Is the first year the medical deduction gonna be 5%?
For everybody who had a medical expense deduction on their 2023 AR or an IR, the ham care deduction in 2024 will just go to 5% instead of the full 10%. If
But
they
there was
didn't,
7.5 after the second year.
yep, that's part of the phase in. So 2024 it will be 5%. 2025 it'll be that 7.5%. And then in 2026 it'll be to the same amount, the 10% that all will be at. So if
And does that only apply to the people that have had a medical deduction each year? So like, for instance, if someone didn't have one, if someone did not have a medical deduction in 23 and they do have medical deductions in 24, does it just go straight to 10%?
yes,
Okay.
if they don't have one in 2023,
I get it. So the phase in only applies to people that have one in 2023. Other than that, starting in 2024 is 10%.
yep.
Okay.
Now that applies to current residents at your property as well as new ones coming in. Maybe not yours because you do ICs, so your Section 8 is going to people that are already residents at your community. But the places that do a move-in certification, if that person is or that household is coming from another HUD property and they had subsidy and a medical expense deduction at property B over there in 2023, when they move into your property in 2024, they are part of that whole phase in as well, are eligible for that. But you would need documentation from the other place showing that they have that deduct. So you would basically have them try to get a copy of their last recertification, which is their file, so they should be able to get that paperwork or request it from that other landlord, which I would assume they are also well aware of this whole situation and be willing to assist, in a perfect world.
But for ICs, it's just gonna be 10%, isn't it?
Yeah, I
Okay.
mean, yeah, there's really no way to do that. They have to be receiving Section 8 and they have to have a medical expense deduction.
So Brian, I'm a little bit confused about, we can start it now as far as counting 2023 as the first year. If the system is going to automatically apply the information when the switch is flipped. So what is it that we're actually using? Just as the streamline procedures, we can start using whatever their assets were from last year, and the income, we're still going to verify that. It doesn't really matter.
So you're going to be streamlining income and assets only, not expenses. And the biggest change when you flip that switch is going to be with the expenses. And you're still doing the full verification. So as long as you are entering the correct information into the system for the January 2024 recertification, the correct assets, income, and their pharmacy and their doctor amounts, or whatever, the correct amounts that you verified or whatever, then when you go into January and we flip that switch and it does the correction, it's going to, it basically just changes the calculation of the stuff you've already entered. It's not really going to cause any other sort of problems. Like the calculation really comes down to mostly the medical expense deduction itself and how much they can actually deduct at that time. So there's really nothing stopping you from doing the self-certification of assets and the self-certification of income as year 2 for this 2024 recertification, because you're still
We should
verifying
start
the
using the new
expenses.
certification questionnaire for all the January certs, which we're in the process of starting now.
Yeah. The only difference between the new questionnaire really is that I've removed questions about having a retirement account and assets. I'll probably have to add something about the different disqualifiers though. But yeah, if you have the old questionnaire still, that's fine. The key point though is the self-certification forms. Where do we go? Here, share the screen. Okay. So the top of each one is where they can indicate what year it is. So you can, as far as year 1 on this stuff, you can probably just stick a copy of this in there and mark year 1. I don't think that really matters too much, because what they put on here is irrelevant in year 1 because you're still doing the full traditional verifications. But for your January 2024 or February 2024 research, you're going to be marking that it's the second year of self-cert if they qualify for it. One of the either their fixed income or their assets being under that 50,000. They really only need to kind of do a little bit of numbering for the things that they have income or assets for. You're used to a lot of the terminology, so helping them fill out like the current balance versus the cash value and stuff like that, or any sort of penalties, you can assist them with what that information is, or explaining what it means so that they can kind of put that what they think the amount is. Again, this is just their best guess to it, unless they know for sure, of course. I mean, it's always better to make sure they're not just completely fabricating everything, but whatever they get in there is whatever they get in there, right? The income self-certification is for each family member. Each person fills one out. And the assets one is for the whole household to include. Now, if they don't have assets, there's a checkbox for that, and then you can just go on with that. But if they have assets, then you got to make sure that they don't check that box at the top here about not having assets, because that would get flagged by North Tampa. Some of the more confusing stuff is kind of here on the end as far as real property, but as long as they just answer those questions to the best of their ability, most of it is just going to be no. I know that there are some people that do kind of rent their previous home or whatever out, and you'll just need like a lease or something from them to kind of document that as not being suitable for occupancy by them, and then how much that income is, so you can calculate that self-employment income, which should also be up on, that would be on the income form. But in addition, there is the disposal of assets form, which is also part of that for each person to fill out. So you may need to print multiple copies of this particular page for that form, for this asset certification. And then, yeah, okay. So you will also need to sign the sign-in date down at the bottom that you witnessed them completing the form, and that you believe that it's as accurate as possible. So and one more thing real quick before questions here.
Okay.
On the income certification form, there's this calculation stuff down here that you will be doing, but you only need to do that if there's a not fixed income source, and that's to determine whether they're a fixed income family or not, 90% fixed income or more. If it's all just Social Security or whatever fixed income source, then don't worry about this calculation stuff down here.
I have a question.
Sure.
So obviously I don't do the certifications here at the property, Erica does. So is Erica okay to sign this form as a witness, or is this something I'm supposed to sign?
Generally, we prefer you do it as the administrator. You're the one that should be signing the certification as well. As long as she doesn't say that there's anything wrong with it, or that there's something that needs to be changed, or like she doesn't believe in the accuracy or that it's the right person, then if she says that it's fine, then you sign it as well, the same way you're kind of signing that 5-9.
Well, yeah, and then also we sign the initial notice.
Yeah, really any sort of official form you guys should be
So basically, you
signing.
don't want the COS to sign this. You want the administrator to sign it.
Yeah, correct.
Okay, I wanted to, can you scroll down on this page? I forget what it was I wanted to ask you, but I wanted to ask you something on here.
Well, that's which one?
No, the other one, yeah, this one here. It's about income that is electrical assistance.
Utility assistance
Yes.
does not include LIHEAP or
Okay.
utility allowances or anything like that. Certain incomes are still always excluded, and primarily any sort of federal assistance programs like.
Well, that's why I was
WIC and
asking,
TANF.
because
Yeah,
so many of the residents get LIHEAP, and that would be detrimental. That would be kind of counterproductive.
yeah. I think this is more from like a charity or something that's offering to provide some monthly assistance to paying their bills, you know, something along those lines, because really all of the other programs like LIHEAP and the utility allowance reimbursement and stuff, that's already excluded and not considered income.
Okay.
Yeah, so any other questions?
Well, the one thing about the house,
Yeah.
if somebody has a home. So what are the things that make it not suitable for them to live in it? I remember you went through this before, but I just want some clarification on that because you had said you have to put if they have income from rental property. So if they have a piece of property, what would be an instance that they wouldn't qualify to go on Section 8 if they have a piece of property? A home.
Let's see. Let me get my Hotma. Here we go. I have a real property exemption form. So if the property is suitable for occupancy, then it has to be considered it's considered real property they could live in, and that they would be uh, ineligible to receive Section 8. But certain qualifications can change that. Like if the property is for sale, then you would have like a actual contract from a housing or a real estate place. If there is a rental agreement, like a lease or something along those lines, which would generally be the case. If the property is not large enough for the size of the family, which may or may not apply because you guys is you're one bedrooms really. There's nothing above that for Section 8, so you're really only looking at two household members. Or if the property is part of an irrevocable trust, not very common as well, but also if the owner of the home is a survivor of domestic violence or other VAWA related things, if there's a disabled family member and the home doesn't provide for their disability related need, or if the property is located so as to be a hardship for the family, so like if it's too far for them to get to work or school, or a medical provider that they need to get to, something along those lines. The only weird one that's in there is if the property is jointly owned by a member of the family and at least one non-household member who doesn't live with that family but resides in the jointly owned property. That's one of the things that needs to kind of get clarified, because it just seems like any couple that splits or something, if that other person who's not part of the household at your community is living in that other property, then it would be exempted. But if they don't meet those exemptions and they have a property that is not like condemned or whatever else, they would be ineligible. Now I'm about to get cut off here, I think. So if you have some more questions here, I'll come back into the meeting here in a second when it kicks me out, and we can kind of continue on a little bit here with it, because I know Hotma stuff there's a lot of fun stuff going on with it. But is also some fun things here between the real property and the asset limit. So that can kind of, even if they're exempted from the real property thing, if it's over the certain value, it could still disqualify them for having over $100,000 in their assets. I'll wait for it to kick me out of here before I get in the middle of a sentence. Less than 1 minute remaining.